So the first one we'll do is dealing with adjusting and paying accrued wages. All right, and let me move my Zoom bar if I can. There we go. Okay, so Pablo Management has 5 employees, each of whom earn $250 per day. They are normally paid on Fridays for the work completed Monday through Friday of the same week. Near year end, the 5 employees worked Monday, December the 31st, and then they had Tuesday off because that was the first, New Year's, and then they worked Wednesday through Friday, January the 2nd, the 3rd, and the 4th. As I said, New Year's Day was an unpaid holiday. We talked about sometimes, when you work, you have paid holidays, so they'll still pay you on the holiday. But sometimes, of course, you don't have that. So this case, they don't have it. So the first thing we're going to do is we're going to prepare the year-end adjusting entry for the wages expense. And then we're going to prepare the journal entry that would be made to record the payment of employee wages on Friday, January the 4th. That we would have on December 31st, we have wages expense. And they're going to show us how we calculate that. So we know that for one day, for 5 employees at $250 a day, we know that we're going to have $1,250 each day. So because of this, because we're doing this because it's going to roll over into the next year, okay, we have to recognize that. So wages expense, wages payable, because we're closing out the books because it's now the end of the year, the end of the fiscal period. So we have a debit to wages expense of $1,250, and then we have a credit to wages payable for $1,250. The expense, what will happen, and we haven't talked about that yet lately, I'm sure we will, is we'll close out, do some closing entries later. So the wages expense will end up being gone eventually. We'll end up doing something with that. The wages payable, that's a liability, and that will still carry forward into the next year. Okay, because obviously come January, they'll have to pay the wages then for that Monday, and then obviously the wages then for Wednesday, Thursday, and Friday of the new year. So then on the 4th then, as I said, we know that on the 1st they're not going to work, which is a Tuesday, because that's New Year's, so they're not going to get paid. So then you have 3 days at $1,250 a day. So that works out to $3,750. So again, you have wages expense for $3,750. Then you have the wages payable for $1,250. And what that does is that clears out, because it's a debit, so it clears out the credit that we made. And I don't know if you can see my pointer, that we made up here. Okay. So we debit that. So it clears the liability. Now we're paying that. So then we're going to pay cash then of $5,000, because now we're paying our employees. So the next one is determining cost flows through accounts, determining the missing amounts in each of the 4 separate situations, A through D. So we had supplies for the prior year that we had left over of, we're looking at A, $400. And then we had supplies that were purchased through the current year of $2,800. So then they had a total of $3,200 worth of supplies available. And then we had the supplies available at the end of the year, which was $650. So they had $400 to begin with. They went ahead and purchased, let's say that was what they had December 31st, let's say. And then January 1st and onward, they purchased $2,800. So they had this amount. And then they had left available at the end of the year, or currently they had $650. So then what was left? They had $3,200 available for use, and then they had left over $650. So then we know then that for the expense for the current year, they used $2,550 of supplies. And they're just showing you here the journal entries for how that would look. So you have the beginning amount of supplies, the purchases that they made. So then this isn't to give, this gives you the total for how much is available. And then we figure out the difference between these. Then they used 2,550. And then we know that our ending balance then in that account is going to be 650. So if we know that they had 7,700 available and that they had left 1,200, then they should have 6,500 is what they had available prior. Okay. But again, we'll look at the T account. So again, at the beginning, they had 1,200 to start out with. Then they added to it 6,500. So then that meant that they had $7,700 of supplies available to use. And then we figured out that the expense was 1,200. So that was how much they used. So then we know that they still should have $6,500 of supplies if they were to go in there and add up their supply cabinet. That's what they should have. So if we look at this one, we say that on C, they had available from the prior year $1,260 worth of supplies. We don't know how much they purchased during the year, but they had available to them $9,750. They had total supplies available for the current year of $1,350, and then the supplies expense is $8,400. So if we look, this was pretty easy because we know then that this is the total. So if we take 9,750 minus 1,250, we know that we're going to get 8,490. So again, the beginning balance, again, looking at C, is 1,260. Purchases we're not sure of, but I told you, we figured it out, was 8,490. So then they had available to them 9,750. And so the ending balance was 1,350. So they had a supplies expense of $8,400. That's what they used. And in this one, you could do this one pretty simply as well. So again, we're not sure right now about how much they had from the prior year, but they had purchased in the current year 3,000. They had a total of 5,288 available for use. And then at the current year end, they had $700 left, and we already know that they had 4,588 was the expense. So again, if we look at this, we go 5,280. Oops. 5,288 minus the 3,000 is 2,288. So the beginning at this point, we weren't sure. Purchases 3,000. They had available 5,288. So we know that they should have available at the beginning 2,288. And so the ending, what they had left over at the end of the current year was 700. So then we know that their expense would have been 4,588. Okay, so adjusting and paying accrued expenses. So the following three separate situations require adjusting and journal entries to prepare financial statements as of April the 30th. In each situation, present both the April the 30th adjusting entry and the subsequent entry during May to record the payment of the accrued expenses. So we'll look at the first one. So on April the 1st, the company retained an attorney for a flat monthly fee of $3,500. And again, the payment for the April legal services would be paid on May the 12th, but they went ahead and retained it. So the first thing you would have to do is, so on April the 30th, we had legal fee expense of $3,500, and that's a debit. And then we have legal fees payable. We have to credit that for $3,500. So the expense, that, remember, that was part of equity, and then the payable is a liability. Okay, so we know that we have to pay that, and we know that we're going to pay that on May the 12th. So then May the 12th, we'll debit legal fees payable, so that clears out the amount that we owed, and then cash $3,500, because now we're actually writing that check, we're actually making that payment. Let's look at the next scenario on B. As of April the 30th, $3,000 of interest expense had accrued on a note payable. The full interest payment of $9,000 on the note is due May the 20th. So let's look at this one. So April the 30th, we had interest expense in the amount of $3,000, and then we have, and that's a debit, and then credit to interest payable for $3,000. Okay. And then on May the 20th, then we have to then pay all of the expense. So we know that cash is $9,000 credit, because we're going to go ahead and pay out cash. So we have the interest payable of $3,000, and that was from April the 30th was the payable, and then we had the expense of $6,000 that was due for May. All right, let's look at this one. Total weekly salary expense for all employees is $10,000. This amount is paid at the end of the day on Friday of each 5-day work week. So these people, they get paid on a weekly basis. Remember that sometimes, and of course we know because we've worked, and I've worked at places where, like for the temp agency where I'm paid every week. Sometimes people are paid every 2 weeks. I know where I work for MCOE and I work for Merced College, I'm paid monthly. So at MCOE, I'm paid at the end of the month, the last working day of the month, and then for the college, I'm paid on the 10th of the month. Okay, so there's obviously different ways, and obviously then that would, but the concept's still going to be the same. Okay, so they're paid weekly. April the 30th falls on a Tuesday of this year, which means that the employees had worked 2 days since the last payday. The next payday is May the 3rd. So we know then that on April the 30th, we have salaries expense of $4,000 because they worked those days. And then we have salaries payable of $4,000. And in May the 3rd, we have salaries expense of $6,000, salaries payable of $4,000 debit, and then cash $10,000, because we're going to go ahead and pay it. What happened here was because April the 30th, that was a Tuesday, so 2 days had passed, $2,000 a day, so $4,000. But we had to close the books, for the month, and so we have that, and that's why it went to payable, because it's a liability for us, because the liability carries forward into the new month. Okay, and so then May the 30th, you have expense $6,000. That's the remaining 3 days, and so then that's how we get that debit, and then we get a credit for 10 because that equals the total. We're going to go ahead now and prepare some adjusting journal entries for the year ended December the 31st for each of these separate situations. Assume that prepaid expenses are initially recorded to asset accounts. Okay, so this is kind of what we were talking about before. We talked about that there were 2 different ways you could do it, and it actually worked out the same way. So this time they did it to the asset accounts. Also assume that fees collected in advance of work are initially recorded as liabilities. And so again, the purpose of adjusting entries is to ensure that all assets and liabilities and the resulting revenues and expenses are properly valued prior to the preparation of our financial statements. And also that every adjusting entry affects one balance sheet account, either an asset or a liability, and one income statement account, which is either revenue or expense, but never cash. And we say that never cash because we haven't paid these out just yet. Okay, so and we know that we're going to pay them out on a later date. So the first thing to do is we're going to figure out the depreciation on the company's equipment for the current year, and we've already figured it out that it was $18,000. So determine the current account balance for depreciation expense. Right now there are none because this is a new company, and we'll determine the current balance, what it should equal, which is $18,000. So then we'll debit depreciation expense on December 31st for $18,000, and then we'll go ahead and record the adjusting entry. So we have depreciation expense. That's going to be a debit in the amount of $18,000 because we have to first deal with the income statement side, and then we'll deal with the balance sheet side, which is the asset, which in this case would be to accumulated depreciation in the amount of $18,000. So remember, you'll have an account in there that says equipment, and that will stay the same. That will be whatever they purchased it at, and then the accumulated depreciation account for equipment, that would keep a record of the depreciation each year. What you would do then is you could take the amount for the equipment, subtract the accumulated depreciation, that gets you the book value of the equipment. Okay. Let's look at another one. The prepaid insurance account had a $6,000 debit balance on December the 31st. So remember, prepaid insurance, that's an asset because we went ahead and paid for our insurance in advance. Before adjusting for the costs of any expired coverage, an analysis of the company's insurance policies showed that $1,100 of unexpired insurance coverage remains. So we still have $1,100 worth of insurance that needs to be provided to us that we've already prepaid for. So we have prepaid insurance unadjusted of $6,000, and then we know then that we should still have left $1,100. And so we know that we've used so far $4,900 of insurance. Okay. So we know then that we're going to have to deal with income statement, balance sheet. So we know that we're going to have to debit insurance expense $4,900, and we know we're going to credit prepaid insurance $4,900 because we want to record any expense debit because that shows that we've used it. And then the prepaid insurance, we have to credit that because we want to reduce what's showing for the asset. We now no longer have $6,000 worth of insurance. We now only have $1,100 of insurance. Okay. Now, the supplies account had a $700 debit balance on December the 31st. Again, remember that supplies is an asset and normally would have a debit balance if it's in the positive, which it should always be. And 3,480 of supplies were purchased during the year. The December 31st physical count showed that we had $300 worth of supplies available. So we originally had 700. We went ahead and purchased 3,480 more. And then we go through at the end of the year, we count what we have left over in our cupboard. And we find out that we have $300 left. So we know then that the current account balance should be $4,180 because we started out with 700, we added 3,480, so 4,180, and then we determined what it should be, which is 300. And you just subtract the two of those, that will tell you what you've used. So then we know then that for supplies, December 31st should have a debit balance of $300 because that's what we have left. And so we've used 3,880 of supplies over the course of the year. So we know then that supplies expense, we need to debit for 3,880 because that shows the amount of supplies that we've used for the year. And then supplies, we will credit that 3,880 because again, that reduces the amount that's in the asset account for supplies, makes everything equal out then to what should be in there now. All right, 2/3 of the work related to $15,000 of cash received in advance was performed this period. Okay, so we have a liability of unearned revenue of $15,000 because we've been paid in advance for work that at the time that we were paid, we hadn't completed it yet. And so we know then that we had 5,000 of it that we still haven't earned yet. We've earned 10,000 of it. So then what you'll do, so we'll go ahead and we'll have to debit unearned revenue for 1,000 because now we're reducing that liability because we've now earned that money. So then we have unearned revenue debit 10,000. Again, that shows that we've used it. And again, remember revenue is part of our income statement. And then revenue, okay, right here, revenue right here. So unearned revenue is actually a liability, excuse me. So unearned revenue is a liability, and then the revenue is income statement. So we now reduced our liability by 10,000, and we've now going to show then that we've earned the 10,000. And that's what that does. All right, the prepaid rent account had a $6,800 debit balance on December the 31st before adjusting for the costs of prepaid rent expired. An analysis of the rental agreement shows that $1,500 of prepaid rent had expired. So we know then that at the beginning we had prepaid rent in the amount of $6,800. We now know now that we should have $1,000 worth of rent because we've used $5,800. So we know that and I think there's a mistake here. Still, same thing applies. It should say rent expense here for $5,800, and then it should say prepaid rent for $5,800. It's going to be the same thing. I know it says the wrong thing there. So we see that. So because we've let's see, this says prepaid insurance, but up here it says prepaid rent, but it's still the same concept. So we see that. Now, wage expenses of $3,200 have been incurred but have not been paid as of December the 31st. Okay. So wages payable, that's a liability. There was none in there. Determine the current account balance. What it should be is $3,200 because that's what we've incurred, but we haven't yet paid it. So then when we go to record this, we have wages expense debit in the amount of $3,200. Again, that is part of our income statement expense. And then because we have the expense, but we haven't paid it yet. And so then we have to show what we have to do. It's a liability then to us. So we have wages payable in the amount of $3,200. Wage expenses of $8,000 have been incurred but not paid as of December the 31st. So we see here that wages payable unadjusted, we didn't have any because we didn't have any liability before. And then we had liability of $8,000. So again, we see we have wages expense $8,000, and then we have wages payable of $8,000. So we have to expense it because we're now at the year end. We want to expense it, make sure our books are right. But then we haven't paid it yet, so it's a liability to us. So it goes to wages payable for $8,000. Depreciation on equipment. So again, you have depreciation expense of $18,000, and you have accumulated depreciation of $18,000. And then the supplies account had a $240 debit balance at the beginning of December. So at that time, we had $240 worth of supplies left at that time, at the beginning of December. Now, during the month of December, we purchased $5,200 in supplies. And then a physical count of supplies was done on the end of December, and that shows $440 of supplies left over at the very end of the month. So again, we figure out the current account balance for the supplies. So we see $240, that's what we had at the beginning of the month. And then we see that we purchased $5,200, so we know that we should have $5,440 in there. And then we figure out how much was left over at the end of the month was $400. So we know then that we're going to make sure that has a debit balance of $400 to show how much supplies we have. So then over the course of the month, we used $5,000 worth of supplies. So we have supplies expense, $5,000, that shows the amount of supplies that we used, and then we have to credit supplies in order to reduce the balance of supplies so that our books match what we actually physically have. Okay. So prepaid insurance account had a balance of $4,000 at the beginning of December. Analysis shows that $1,200 of unexpired insurance benefits remain at December 31st. So we see that it should be started out with $4,000, but we have left $1,200. So we know then that we've used, over the period, we've used $2,800 of insurance. So we have insurance expense, debit, $2,800. That shows how much insurance we've used. And we see then that we have currently, in order to reduce this, we have to reduce down how much. And remember, prepaid insurance is an asset, so we have to reduce it down to show what is currently in there. So normally, to add to an asset, you would debit, but in this case, we have to subtract, so we would credit that $2,800. Now, the company has earned but not yet recorded $1,050 of interest revenue for the year ended December 31st. The interest payment will be received 10 days after the year end on January the 10th. So we know we've earned it. So interest receivable to start out with, and again, that's an asset. Start out with is $0, but then on December 31st is $1,050. We know that we're going to get it. We just haven't received it yet. So then we would debit interest receivable $1,050 because it's an asset. To increase an asset, you have to debit. Interest revenue, you will credit $1,050 because that goes on the other side of the equation. For the revenue, we want to recognize the revenue. The company has a bank loan and has incurred but not yet recorded interest expense of $2,500 for the year ended December 31st. The company will pay the interest 5 days after the year end on January the 5th. So we know to start out with, for interest payable, the balance is $0 because we didn't owe anything previous. But we know that on December 31st that we owe $2,500. Again, remember that interest payable, it's a payable, so that is a liability. So then you have interest expense of $2,500 because you have to increase the expense. In order to do that is to debit, and then the interest payable, you have to credit that for $2,500 because you have to increase the liability. So remember, because liability, it's on the other side of the equation. In order to increase it, you have to credit it. Following are two income statements for Alexis Company for the year ended December 31st. The left column is prepared before the adjusting entries are recorded, and then the right column is prepared after the adjusting entries. Analyze the statements and prepare the seven adjusting entries that likely were recorded. Hint: entry 4A refers to fees that have been earned but not yet billed. Okay. So we see here that we had accounts receivable in the amount of $7,000 and then we had fees earned in the amount of $7,000 debit. And the reason for, or credit, the reason for that is, if you look, there's a difference here of $7,000. So they knew that they should have received $7,000 from their customers. And so we have, again, the income statement, remember, just shows one part of it, but we know that the assets have to match as well. So we see here the fees earned went up $7,000, and then we see, so we have to credit that to increase it. And then we see here that accounts receivable will debit that because that increases the asset, which we don't see here. And then if we look on the depreciation of the computers, we see that they didn't have any to begin with, but at the end of the year they had $1,600. So we have depreciation expense on the computers, debit that for $1,600, because for expenses on that you will debit it to increase it. And then we have an accumulated depreciation of computers is a credit of $1,600. Because what happens then is you have, let's say on the books, you'll have an asset and an account for computers, which normally debits and has a debit balance. But if you take that and then you have a credit then of $1,600, you'll subtract that. That then tells you how much the computers are worth currently. Okay. And then we have salaries expense and salaries payable. So we see here that had increased. So we have salaries expense of $2,250. So those are salaries that we've used, so we know that we have to pay that. We haven't paid it yet, so because we haven't paid it yet, it's a liability. So we go to salaries payable, $2,250. Same thing with insurance expense. So at the beginning, they didn't have any expense for the insurance, but then they used $1,400 of the insurance. So we had insurance expense, debit for $1,400, and then prepaid insurance is an asset. We have to decrease the asset for the amount that we've used. So we will credit prepaid insurance $1,400. Same thing here for office supplies. We used $580 worth of office supplies. So we have office supplies expense debit for $580. And then we have to credit office supplies, the asset office supplies, by $580 because we want to reduce and make sure everything agrees to what exactly is in there now. Same thing with utilities. We've used $90 of utilities. We haven't paid the bill yet, so it's a liability to us because we owe it, we haven't paid it. So we will credit utilities payable $900. Go ahead and prepare the year-end adjusting journal entries for M&R Company as of December 31st for each of the following separate cases. Entries are drawn from the following partial chart of accounts, and so we'll deal with cash, accounts receivable, interest receivable, equipment, wages payable, salaries payable, insurance expense, lawn services payable, unearned revenue, interest revenue, wages expense, salaries expense, supplies expense, lawn care expense, and interest expense. So the first one is M&R Company provided $2,000 in services to customers that are expected to pay the company sometime in January following the company's year end. So we did the work in December. December now is finished, and so our customers won't be paying us now until January. So to start out with, we don't have any accounts receivable. Everybody has paid us. But we know that we're owed $2,000. So we have to go ahead and put a debit entry for accounts receivable, $2,000. And again, the reason for that is because accounts receivable is an asset. And so in order to increase an asset, we use a debit. So we see here that on December 31st, we will record accounts receivable debit of $2,000. And then we have to recognize, even though we haven't been paid for the service yet, we still completed it. So it's part of our revenue, so which goes on the income statement. So we will credit $2,000 to services revenue. Wage expense of $1,000 has been incurred but not paid as of December the 31st. So again, we see here that to begin with, wages payable, that's a liability. To begin with, we didn't have any balance in there, but we now have a liability of $1,000. And so because it's a liability, it's on the other side of the equal sign. And so to increase a liability, you credit it, 1,000. So then we see the credit there and in the debit. So the debit would be wages expense 1,000 because we've used the wages. So we add $1,000 debit in order to show that and increase the expenses side. And then we have wages payable of 1,000 credit because we owe now $1,000. And so to increase the liability, we have to credit it. Now, M&R Company had a $5,000 bank loan and has incurred but not yet recorded 8% interest expense of $400 for the year ended December 31st. The company will pay the $4,000 interest in cash, or they'll just take it out of the account or whatever, on January the 2nd following the company's year end. So to start out with, we don't have any liability for interest because we either already paid it or this is a new loan. But we know then that we should have $400. So because again, interest payable, it's a liability. So to increase the liability, we have to credit. So we'll enter an entry for December 31st, a credit of $400. So we can do that. And then it goes for interest expense of $400 because expense goes on the income statement. To increase an expense, we debit. So we'll debit the interest expense, and then we will credit the interest payable by $400 because that shows what we owe, the liability. M&R Company hired a firm to provide lawn services during December for $500. M&R will pay for December lawn services on January the 15th following the company's year end. So maybe we didn't have lawn services before, so start out with is 0. And then we have $500. So we have, because again, lawn services payable, it's a liability. So in order to increase a liability, we have to credit that. And so we owe $500 because we incurred it in December, but we haven't paid it yet until January. So it's something that we owe. So then we see here that we will debit lawn service expense for $500 because we have to show the expense there. So we'll debit that to increase it, and then we'll credit lawn services payable by $500. M&R Company has earned $200 in interest revenue for investments for the year ended December 31st. The interest revenue will be recorded or be received on January the 15th following the company's year end. So we see that interest revenue to begin with, they didn't have any, but we'll do a debit because, again, interest receivable is an asset. So to receive it and add to it, we debit it. So we'll debit it for December 31st of 200. So insurance receivable is an asset. So we debit that 200 in order to increase it. And then it's part of revenue. So in order to increase revenue, we have to credit it by $200. So interest revenue. Salaries expense of $900 have been earned by supervisors but not yet paid as of December 31st. So we see here that salaries payable unadjusted, we didn't have a liability previous. We're adding the $900 to it. So again, liability, to increase the liability, we credit it. So we had salaries expense debit of 900 because that shows, again, the expense increases, showing how much we've used in the expense. And then salaries payable will credit that 900 because that is a liability. We still owe it. We have to increase our liability. Following are the accounts and balances of the adjusted trial balance of Stark Company. So we'll prepare the income statement, the statement of owner's equity for the year ended December 31st, and the balance sheet for December 31st. The Stark capital account balance was $24,800 on December 31st of the prior year. So we're going to look at this, and then we're going to go ahead and list out for the adjusted trial balance. So again, these are all assets: cash, accounts receivable, supplies, insurance, prepaid insurance, and buildings. Those are all assets, so those are all debits, balances. Accumulated depreciation buildings is a credit, $15,000, because again, if you take $40,000 minus the $15,000, you'll get how much the buildings are worth today. And then now we're on to our liabilities. So accounts payable is a liability, $1,500. Wages payable, $400. That's a liability. Interest payable, $100. That's a liability. Unearned revenue is $800. That's a liability because people have paid us for services that we have not yet rendered to them. We've not given them the services. Notes payable, $11,000. So we owe money to the bank. And then Stark Capital, that's part of equity. And right now, Stark is worth $24,800. And then he's taken out so far $3,000 of that. So we debit the withdrawals for $3,000. And then the service revenue is for $20,000. So we've done services of $20,000. And so that's revenue that we have generated. And then we have interest expense of $500 because we've used that. We have wages expense of $75. We have insurance expense of $1,800. And then salaries expense of $200. Again, just showing the utilities, the insurance, the wages, all of that we've used. Okay. And then you notice here that it balances out $73,600, $73,600. So we know that everything, the balances are on the correct side. Oh, we're doing the balance sheet first. So the first thing we'll do is our balance sheet. So we see we have assets of cash, $10,000, accounts receivable, $4,000, supplies, $800, prepaid insurance, $2,500. And then we have buildings of $40,000, but we have accumulated depreciation on buildings of $15,000. So then our buildings right now are only worth $25,000. So then that equals $42,300 of assets. In our liabilities, we have is accounts payable, $1,500, wages payable, $400, interest payable, $100, unearned revenue of $800, notes payable of $11,000. So it equals total liabilities of $13,800. So that's the amount that we owe. And then we'll figure out the equity later. So we're going to do the statement of owner's equity. So start capital at the beginning of the year was $24,800. And then if we figure out the income statement, we see that we had revenues, service revenue of $20,000, and then we had expenses of interest expense of $500, wages expense of $7,500, insurance expense of $1,800, utilities expense of $1,300, supplies expense of $200, and then we have the accumulated depreciation buildings of $2,000. So that $2,000 happened during the year, and we haven't yet figured that into the accumulated yet. So then we had total expenses of $13,300. So we had a net income. Another way of saying net income would be a net profit of $6,700. So we add that under the statement of owner's equity. We add that net income, $6,700. So then the total then for start capital is $31,500, excuse me. But Stark took out $3,000, so we subtract that. That equals $28,500. So we take Stark capital, the new balance for the year end, $28,500. So then our total liabilities and equity are $42,300. Both sides, our asset side and our liability equity side balance. So we know that everything should be correct. So we're going to use the following information to do profit margin for each separate company. And so what you'll do, and I know that there's a question on this, is to figure out profit margin is going to be the net income divided by the net sales. So we know then net income, again, another way of saying net income is profit. So we take 4,361 divided by 44,500 is that. But if we times that by 100, we know that we had a 9.8% profit margin. Okay, let's look at the next one. So we know that for B, we know that we had a 24.5% profit margin. Would anybody like to do number C? So we have 111,281, and then we'll divide that by 257,000. So that is 0.433. If we multiply that by 100, it's 43.3%. And then the next one, 65,646 divided by 1,458,800 times 100 is a 4.5%. So they had a lot of sales, almost $1.4 million worth of sales, but they only made 4% on all their sales. So that's what this is telling you. This is telling you, so the next one is 18.4% for E. So this is, the profit margin is telling you out of their sales, how much out of their sales after you subtract the expenses, how much did they actually profit? How much did they earn? Okay. It gives you an idea of the profitability of your business, and maybe if it's not where you want it, there's some adjustments that you could make in order to make things better. But notice D, they had 1,458,000 in sales. Doesn't that seem like that business should be doing pretty well? They had a lot of sales. What do you guys think?
I think it's fine.
It's fine. Yeah. I mean, I think any of us, I think, would be pretty impressed by that, wouldn't we? To think, wow, we made a lot of sales. I'm just trying to prove a point here. So we had a lot of sales, right? But we probably also, if we only had a net margin of 4.5% for a profit margin, we probably had a lot of expenses that went along with that too, right? So maybe we're in a high rent building. Maybe we're an airline. So we had to buy airplanes. We had to buy fuel. We had to pay for maintenance on our planes. We had to pay for the pilots and all the other staff. I mean, the airlines, they have a lot of revenue, but they don't necessarily make a large profit because they also have very high expenses. Or, for example, if you look at, I don't know, any of you guys shop at Save Mart or shop at Rayleigh's and you think, wow, they're making a lot of sales, every minute they're making a lot of sales. But they also have a lot of expenses because they have to pay for the building, they have to pay for maybe for rent or mortgage on their building, for the employees, pay for all of the products, all of those things. I mean, an average grocery store doesn't make maybe 2, maybe 3% if they're lucky, profit margin. So I just wanted to talk about that again, just to show you, just because a business makes a lot of sales, that doesn't necessarily turn into the profit. The profit, that's the bottom line. That's the thing that businesses are really concerned about and investors are concerned about. Which of the 5 companies is the most profitable according to the profit margin? Which company there would you say is the most profitable?
See?
C, absolutely, because they have a higher profit margin, right? So just because they had the sales, but then they also probably didn't have a lot of expenses either. So they had 44,100 left over. So they had a higher profit margin, which is interesting because if you look at like E, they had 190,000 in sales. Theirs was a little bit less. Or D, they had a 110,000 of sales, but they only made 2.9, a little bit less than 3% of profit. They only made $3,000. I mean, that's kind of interesting again to look at. Ricardo Construction began operations on December the 1st. In setting up its accounting procedures, the company decided to debit expense accounts when it prepays its expenses and to credit revenue accounts when customers pay for services in advance. So then we'll go ahead and prepare the journal entries for these. So the first one is for supplies. Supplies were purchased on December the 1st for $2,000 in cash. So we have supplies expense, $2,000, and then we have cash for $2,000, because rather than applying that supplies to the asset account, we're just going to go ahead and expense them right now so that they bought them. So supplies expense $2,000, and then cash a credit for $2,000 because the cash is what they paid out. And then it says the next one, B, is the company prepaid its insurance premiums for $1,540 cash on December the 2nd. So we see here insurance expense, $1,540, and in cash, $1,540. So they're going to go ahead and expense it right away. So $15,040, and then they paid cash for the same amount to reduce the asset. Now, on December the 15th, the company received advance payment of $13,000 cash from customers for remodeling work that hadn't yet been fully completed. So we have cash debit for $15,000 excuse me, 13,000 because we have to increase the cash to recognize the increase in the asset. And then we have remodeling fees earned of 13,000, which is a credit because we had revenue of that. And then on December the 28th, the company received $3,700 cash from another customer for remodeling work that would be performed in January. So same thing. So we have cash, the amount of $3,700, and then you have remodeling fees earned for $3,700. So this company, what they decided to do, they're not putting it into unearned because they're just going to go ahead and say they earned it even though they haven't completed the work yet. Okay. They're just recognizing it as it's being done. So they're doing more of like a cash basis. What we've been talking about before would be more of like an accrual basis. So we see here that E, a physical count on December the 31st indicated that the company had $1,800 of supplies available. So then what we would do then is we would go ahead and debit the supplies 1840 because that's going to show what we have currently. And then supplies expense, we will credit that 1840 because because we already expensed it, but we want to correct it to show how much we currently have in supplies. And then F, an analysis of the insurance policies in effect on December 31st shows that $340 of insurance coverage had expired. So we had the asset of prepaid insurance is for $1,200, and then we had insurance expense of $1,200. So that's what, again, showing what we currently have in there now available to us to still use. So we're just correcting that. And then for G, as of December the 31st, only one remodeling project has been worked on and completed. The $5,570 fee for that project has been received in advance, recorded as remodeling fees earned. So now we have remodeling fees earned debit of $11,130, and then we have unearned of $11,130. Again, it's just to correct that. Constanza's company experienced the following events and transactions during July. So they received 3,000. Okay, we'll do this. So we'll go ahead and prepare the journal entries, including the adjusting entries at the end of the month to record these events using the procedure of initially crediting the unearned fees account when payment is received from a customer in advance of performing services. So the first one is they received $3,000 cash in advance for performing work for this Vivian Solano. So we had cash debit of $3,000 because we want to increase our assets. We've received $3,000. And then we had unearned fees of $3,000 because we've received the cash, but we haven't done any work yet. And then on July the 8th, we had cash of we received $7,500 cash in advance of performing work for Iris. So we received cash of $7,500, and then we also, same thing, had unearned fees of $7,500 because we haven't done anything yet to earn it. And then on July the 12th, we went ahead and completed the work for Solana. So we will debit the unearned fees for $3,000, and we'll go ahead and credit the fees earned because we've now earned the fees. So we're going to debit in order to remove it from the unearned fees, and then we'll go ahead and credit that to the fees that we earned. And then on the 18th, we received $5,800 cash in advance for performing work for Amina Jordan. So we received cash, the amount of $8,500, so we'll debit cash. We'll go ahead and credit the unearned fees, $8,500, because we received the cash, but we haven't done the work yet. And then On the 27th, we completed the work for Haru. So we have fees earned of $7,500, debit because we've now earned those fees. And I think they made a mistake there. It should be unearned fees, debit of $7,500, and it should be a credit to fees earned for $7,500. And then for July the 31st, it said that none of the work for Jordan had been performed. So for July the 31st, we wouldn't have to make any kind of a journal entry yet. We still have the money for Jordan on our books under the unearned fee revenue. And so we either have to perform the work, or we would have to, if we couldn't perform the work, we would have to issue a refund. We still owe her that. And then we'll go ahead and, so we did our journal entries, then we'll prepare the journal entries or any adjusting entries as of the end of the month to record the events using the procedure of crediting the fees earned account when the payment is received from customer in advance. So the first A is usually what you would do. You would have to credit the unearned fees account when you receive money. Debit cash, credit unearned fees. But in this next one, we're going to basically do the same thing, but instead we'll debit cash to increase cash, and then we'll go ahead and credit the fees earned as we receive the funds. So you'd have a debit to cash for $3,000, fees earned for $3,000. And then the next one would be the same thing, but just the fees earned. So then when we complete the jobs, then we don't have to do anything. So for July the 12th, we completed the job for Solana. We don't have to do anything for that. And then we receive cash in advance of performing work for Amina. We don't have to do anything. We just do that. Then we completed the job for Haru. We don't have to do anything. But now, in this case, because we've not done the job for Jordan and we're closing out the books for the month, we do have to do something. So before we didn't have to do anything for the one, what happened on July 31st, but if we do it this way, we do. So we had fees earned of $8,500 debit because we haven't earned the fees yet. We haven't done the work, so we debit it instead of crediting it. We're going to debit it in order to reverse it out. And then unearned fees, we're going to go ahead and credit that for $8,500 because we haven't earned the fees yet. We still have to perform the work. And then under each method, determine the amount of fees earned reported on the income statement and the amount of unearned fees. So we see here let me go back to that. I'm sorry. Okay. So we see here that in actuality, either way that you do it, you're going to come out with the same balance no matter what. So either way technically would be correct. You just have to keep track of that, what you've done in terms of what work you've completed, what fees you've earned, and what work you haven't completed. You just have to keep track of that. But either way, you're going to come out with the same balances for your income statement and the same balances for your balance sheet. So either way that you do it, it's going to work out the same way. I just wanted to show you that. All right. So